Hello everyone and welcome back to the podcast. In this episode, we're going to be taking a deep look at Rivian's 100x case. So how can this stock go up 100x over the long run? And in fact, this idea is not as wild as you may think, because essentially this company has tremendous process power. And so it's more likely than not that they will emerge successful. I'm not saying the stock will 100% go up 100x over the long term, but essentially here's the case. Traditional manufacturer OEMs can't keep up with the demands of digitally native customers. And now what's going to happen is that new OEMs will take their place as platforms in a second major consolidation of the auto industry, with Rivian contending for a number 2 position behind Tesla. At a market cap of just over $17 billion today, if Rivian does become a platform that other OEMs use worldwide to keep up with the evolving software landscape, this company can become much more valuable. It can be worth $200 billion or even trillions of dollars, as it effectively becomes a platform that rents out an operating system that enables other OEMs to bring things to life at scale, like autonomous driving and other software-based features. Okay, so let's take a deep look into this thesis. OEMs worldwide will soon be defaulting to Tesla's operating system because the vertically integrated infrastructure required to yield autonomous driving and other software-based features is simply excessive for the industry at present. In this regard, Rivian is a strong contender to a number 2 position, and at a market cap of $17.29 billion, the scenario may evolve over the coming few quarters to yield considerable upside. So essentially, a number of things are happening inside the company that make it worth watching over the coming few quarters, because it may come to this situation where the upside in the thesis becomes quite interesting. As you can see in the graph below, this wouldn't be the first time the industry experiences a similar dynamic. The 20th century saw small OEMs, known as original equipment manufacturers, the companies that make cars, succumbing to the manufacturing expertise and thus superior unit economics of the larger OEMs. The small brands that survived ultimately did so because of the way they made customers feel, thus obtaining a prominent mindshare in the marketplace. Notable examples of such smaller brands in the US that you can see in the graph below include Cadillac, Jeep, Dodge, and others. In effect, these larger OEMs have acted as platforms that smaller brands have piggybacked on, as these platforms have compounded fandom from the prominent mindshare that I was talking about. With increasingly cost-effective manufacturing over the decades, it has become exponentially more difficult for non-affiliated brands to enter the marketplace at all. This is best evidenced by the declining number of new American car companies along the 20th century. As a result, a number of large and profitable manufacturer OEMs have emerged across the world. Notice how in the graph below, Tesla's cash from operations in dollars, the red line, doesn't quite stand out among the large manufacturer OEMs, yet, like Volkswagen in the purple line, Toyota in the blue line, Porsche in the green line, and others. In the next graph, you can see equally how Tesla doesn't actually stand out in terms of profitability either. These OEMs are therefore still great businesses, despite the rapid evolution of the industry seen since the start of this decade. It shows how lucrative jumping into these platforms early can be, and why Rivian is worth studying closely, especially as its financials converge towards the positive domain. I cover this in depth in the next section, by the way. Now, going back to the big picture, as we continue moving towards software-defined vehicles, we are likely to see a new set of platforms emerge that help smaller brands to cost-effectively keep up with the ever-evolving needs and wants of digitally native customers. Yet, this new landscape will have less and more enduring winners, because the software platforms will effectively be networks. You'll be wondering, what do I mean by this, that these platforms will be networks? Consider the following. Tesla doesn't explicitly tell its cars how to drive around, when they do so autonomously, but rather lets their network of cars learn from real experience on the road. Those learnings are then retroactively etched into the software via neural networks that reprogram their parameters as the fleet of cars continue to accumulate more miles driven on the road. The more cars on the road, the better the resulting AI is likely to be, and by extension, the more appealing the operating system will be to other car brands. So basically, these new platforms are essentially networks that connect cars together, and the more cars you have on the network, the better the software gets. Networks tend to winner takes all scenarios, and it may be that Tesla takes all of this market. In such a scenario, investing in Rivian would be pointless, but I suspect that the market may accommodate more than one platform over time, because the market will be truly huge. If so, Rivian is the most likely candidate to step up to a platform role behind Tesla, with the former now seemingly tracking towards an inflection point that I cover in depth in the next section. The main takeaway from this section is that Rivian seems to be a few quarters away from gross profit, but it actually goes much deeper. And getting deeper into this topic is what truly enables you to see what the market is currently not seeing, which is the fact that this company can truly get much, much bigger over time. So let's get deep into it. Apart from Tesla, Rivian is the only company in the West that fully controls the perception stack that you can see depicted in the graph below. The perception stack is the vertically integrated infrastructure required to enable cars to pick up information on the road and turn it into insights, effectively unlocking autonomous driving and other software-based features. The stack goes all the way from sensors to the data center, where data gets processed, typically in large GPU clusters. Without it, there is no way of keeping up with Tesla. The competitive dynamics at the perception stack level are like in any other network. Faster and better iteration than others leads to more participants in the network, yielding more data and thus more value. Success is largely a function of iterating faster than competitors, and so abstracting away physical constraints is paramount. The latter is actually what makes this endeavor most difficult and is the primary reason for Rivian's lack of profitability. Here's what Rivian CEO RJ Scaringe, I hope I'm pronouncing that well, said during the Q1 2024 earnings call.
Our vertically integrated hardware and software capabilities enable continuous enhancements to the product.
However, Rivian's gross margins continue to converge towards the positive domain, as you can see in the graph below, with management executing exactly as they said they would every quarter. So management seems to be very reliable, and the company just seems to be coming up with one optimization after another, exactly as promised. During Q1, Rivian focused on updating the tooling in its quote-unquote normal factory, which is basically where it produces all of its cars today, which according to management has negatively affected gross margins by 9.5%. In the graph below, we can see what gross margin evolution looks like in the red line if we normalize for this factor. And so the trend is actually quite appealing at the moment. In Q3 and Q4 2023, gross margins were negatively affected by a slowdown in deliveries, which has been widespread across the electric vehicle space, and the transition towards lower-priced models, such as the Rivian R1S and R1T. However, it seems that once again, the company's process power is shining through, as evidenced by the inflection in gross margin evolution. Management now actually expects to achieve a positive gross profit in Q4 2024. Here's what the CFO said during the Q1 2024 earnings call about this matter.
We expect to see meaningful improvement in our gross profit during the second half of this year and believe we will reach a positive gross profit for the fourth quarter.
My general impression, having studied Rivian for just under a year now, is that everyone in the organization, or most people in the organization, are obsessed with continuously driving incremental efficiency, and that this is a cultural factor that can be relied on. This qualitative perception of mine is fairly evident, I believe, in the long-term evolution of 12 trailing month gross margins that you can see in the graph below. When I wrote my original Rivian deep dive, which you can find in my Substack, management promised a 60% reduction in ECUs, electronic control units. Together with a retooling of the normal facility, as of Q1 2024, Rivian has successfully transitioned towards said new ECU architecture, which takes quote-unquote substantial costs out of the vehicles. In turn, the tooling upgrades have enabled Rivian to transition from 3 to 2 shifts in R1 production, increasing the R1 line rate by 30%, and they have also improved the flow of materials and inventory across the facility. Management seems to believe that the above 3 improvements will catalyze the move towards gross profit, since they promise to have an outsized impact on variable costs. However, according to management, this won't equate to a significant volume increase in the second half of 2024. Here's what the CFO, Claire McDonough, said during the Q1 2024 earnings call about variable costs.
The largest driver for us in our path to positive gross profit remains the improvements in variable cost reduction.
When I first studied Rivian, the company had just gone through an inflection point in the cost per car delivered from Q1 to Q2 2023. This was due to the introduction of the new Enduro engine unit and the LFP lithium iron phosphate battery pack. In effect, the improvements in the normal facility seen in Q1 2024 are not a standalone event, but rather a continuation of a long string of optimizations. In my view, this can only be explained by an organization that is genetically focused on what matters, and thus, unless we see abrupt cultural changes in the near future, Rivian is likely to hit positive gross margins soon. Here's a quote from CEO RJ Scaringe during the Q1 2024 earnings call, which I think is quite revealing about the company's culture.
We're constantly driving incremental efficiency across the organization as a whole. And so that intensity and focus is what's enabling our path to reduce our operating expenses overall for the year, but also importantly, seeing that second half 2024 step change reduction in OPEX.
A new dynamic that I see kicking in beyond Q1 2024 is compounding efficiencies. So with the launch of the R2 and R3 models, Rivian is now positioned to further leverage the efficiency gains obtained on the R1 platform. And overall, I think this is going to radically increase the company's capital efficiency in the coming 2 to 3 years. Per the remarks of RJ Scaringe, the R2 and R3 enable Rivian to further leverage the efficiency learnings obtained by iterating the R1 platform, because they don't have as high capability requirements. By enabling Rivian to essentially repackage and sell its perception stack across a much larger surface area, the R2 and R3 promise to enable Rivian to radically expand its TAM at a marginal cost and ultimately increase profitability down the line. As I was saying, this paves the way for higher capital efficiency in the future across the board. So here's what the CEO said about this during the Q1 earnings call.
As we wind that forward into R2, R2 is a fundamentally different architecture. It's built to a different set of requirements. R1 has a very extreme set of requirements in terms of on and off-road capability, whereas the R2 product will still be very capable both on and off-road, but not to the true extreme that the flagship product has.
According to RJ, the R2 has also been designed to ramp quickly, leveraging the lessons learned from previous launches. Further, by starting R2 production in the normal facility, which is something that the company announced this quarter, and it's actually a different plan to the one they had before this quarter, Rivian expects to reduce capital needs by $2.25 billion between now and the start of production. Additionally, the aforementioned efficiency increases brought about the latest update of the normal facility have led to management reducing fiscal year 2024 capex guidance from $1.2 billion to $500 million. As a result, the current cash balance is now expected to last until the mid-2026 point, which is great news. However, it must be noted that, of course, liquidity is still an issue, and therefore the risk of permanent loss of capital is tangible for investors. So when I was saying that this scenario may yield considerable upside over the coming quarters, it's, I believe, likely that Rivian will at some point hit a positive gross margin in the coming few quarters, and then that will gradually de-risk the thesis by enabling the company to get closer to a point in which they can start producing positive cash from operations. But of course, at present, this is still a relatively risky investment in which you could lose all of your money. My conclusion from this deep dive update is that this company is worth watching closely over the coming year. Car brands essentially thrive by having a vibe and then getting more efficient at manufacturing over time, so effectively compounding the resulting fandom with increasingly effective manufacturing. That's how car brands grow the top line and then bring a substantial percentage of it down to the bottom line. Rivians indeed have a strong vibe, and the company is progressing adequately in the pursuit of profits. Some companies falter along the way, but Rivian has continued progressing against all odds, including a period of rampant inflation in the recent past, and even more recently, a subsequent period of waning electric vehicle demand. The long-term progression of Rivian's financials denote a culture that is obsessed with continuously optimizing processes and delighting end customers. This is why I think it is more likely than not that Rivian's financials will inflect into the positive domain in the near future, and then beyond that, the future can be very, very bright if indeed Rivian does become a platform for other OEMs worldwide, as I believe Tesla is actually quite certain to become. Although the risk of permanent loss of capital is considerable, I believe this company is definitely worth watching closely going forward. To cap off this update, I believe that a number 2 position in the emerging auto operating system market is likely to be far more valuable than Rivian's market cap at present, of just over $17 billion. So I'm excited about tracking Rivian, and I will definitely be updating my thesis going forward. So until next time, thank you very much. And if you enjoyed this, please, can I ask you one favor? Just share it with one friend whom you think may enjoy it. Take care, and thank you very much.